I want to start with a story. A family came into my branch one Tuesday morning. They had been saving for 5 years for a down payment on their first home. They were so excited they could barely sit still. I pulled their credit and my heart sank. Not because they were bad people, not because they had not worked hard, but because of one missed payment, $82, from a bill about a year earlier that they had completely forgotten about. That single item had dropped their score just far enough that I could not give them the rate they needed to make the numbers work. I had to watch them walk out without the approval they came for. That moment is a big part of why I am here. Nobody told them what I am about to tell you, and it should not have happened. Welcome to Sense and Simplicity. I spent 20 years in banking and finance, including 8 years as a branch manager. I sat across from thousands of families in moments that shaped their financial lives. Some of those moments were great, and some were heartbreaking. Most of the heartbreaking ones were completely preventable. This channel is here to make sure you have the information you need before you walk into that office. No jargon, no judgment, just what actually works. So what is a credit score? It is a 3-digit number between 300 and 850 that tells every lender in America how risky it is to loan you money. The higher the number, the less risk they see, and the better the terms you get. Lower interest rates, higher loan amounts, better mortgage offers. But here is what most people miss. The number is just a summary. Think of it like a GPA from school. The GPA showed one number, but underneath it was every test, every assignment, every absence. Your credit score works exactly the same way. When I pulled your credit at the bank, I did not just see the number, I read the whole story. Your score is built from 5 specific factors, and knowing these changes how you make financial decisions. The biggest factor is payment history. 35% of your score. That is more than a third, and it measures one thing only. Did you pay your bills on time? Not eventually, on time. One payment that is 30 days late can drop your score by 50 to 100 points, depending on where you started. That is not a rounding error. That is the difference between getting approved and getting denied. Second is credit utilization, 30%. This is how much of your available credit you are actually using. If you have a card with a $10,000 limit and you are carrying an $8,000 balance, your utilization is 80%, and lenders see that as a red flag. Keep it under 30%, under 10 if you want to be in truly strong shape. Third is length of credit history at 15%. How long have your accounts been open? This is exactly why closing your oldest credit card, even one you barely use, can quietly hurt your score. That old account is like job seniority. The longer it has been there, the more it is helping you just by existing. Fourth is credit mix at 10%, whether you have different types of credit, like a card and a loan. And fifth is new credit inquiries, also 10%. Every time you formally apply for credit, a hard inquiry hits your report. A couple is normal. 6 and 3 months tells lenders something might be wrong. When I pulled your credit file, I was not just looking at the score on the front page. I was reading every account you had ever opened, every payment you had ever missed, every time someone had run your credit in the past 2 years. I could see your total debt load, whether anything had gone to collections, and how long you had been managing credit. The score tells me the headline. The report tells me whether I can trust it. Both matter every time you apply for anything. Let me translate the actual score ranges into plain language. Under 580 is poor credit. You will struggle to get approved for most standard products, and if you do, the rates will be significantly higher, which means you pay more over time for the same things. 580 to 669 is fair. Some products become available, but you are not getting the best deals. Lenders see risk here. About 14 months after I had to turn a couple down for a mortgage, they walked back into my branch. The first time I met them, their score was 611. Close, but not where they needed to be. I sat with them for about an hour that first visit and walked through exactly what was pulling them down. 2 credit cards, both near their limits, and 1 old medical bill in collections. They came back with a 683. They had paid both cards down, disputed the medical collection and had it removed, and had not missed a single payment the entire time. I approved their mortgage that same afternoon. A few weeks later, they sent me a card with a photo of their kids standing in front of the new house. That is what what understanding this system can actually do for a real family? Before your action step, I want to clear up 3 myths I heard constantly as a banker, because believing any of these is quietly costing people money right now. Myth 1: carrying a small balance on your credit card helps build your score. I heard this weekly. It is completely false, and it is expensive. You do not need to carry a balance and pay interest to get credit for using the card. Pay it in full every month. The credit bureaus see the activity. You get the benefit without paying a single dollar in interest. Myth 2: checking your own credit hurts your score. This keeps people from looking at their report for years, and in that time, problems just sit there getting worse. Checking your own credit is what is called a soft inquiry. It has zero effect on your score. The only thing that actually hurts you is not knowing what is on there. Myth 3: closing a credit card you do not use will help your score. This one feels logical. You paid it off, close it, move on. But closing it reduces your available credit and can shorten your credit history. And both of those things push your score down. If there is no annual fee, leave it open. Put one small recurring charge on it, a streaming subscription, anything, to keep it active and help your score without any extra effort. Here is what I want you to do this week. Go to annualcreditreport.com. That is the only official government-authorized free site, not the ones with the jingle on television, not the ones asking for a credit card to start a free trial. Annualcreditreport.com. Pull your report from all 3 bureaus: Equifax, Experian, and TransUnion. Look at every account listed. Check for anything that is not yours. Look for the words collection, charge-off, or derogatory. Checking it does not hurt your score. What hurts is not knowing. The family from the beginning of this video came back 8 months later. They fixed what needed fixing and they got their home. Your credit score is not a verdict. It is a starting point. And you now understand it better than most people who have been using credit for decades. If this video helped you, or if you know someone who has been confused about their credit score, share it with them. It costs nothing, and it could genuinely change their financial future. If you have a question about anything I covered today, drop it in the comments below. I read every single one, and your question might become the next video. And if you are not subscribed yet, now is a great time to do that. Hit the subscribe button and the bell so you never miss a video. Everything on this channel is free, it always will be, and there is a lot more coming. I will see you in the next video.